Okay, we are live. We are live. Welcome, everyone. Welcome to another one of Carolina Retirement Planners' regular weekly happy half hours. And as you can see, my daughter and partner in the business, Sam, is with me. But also with me is Phon Vilayoune. He is the founder and president of Smart Veda, a group that we use a lot to help manage people's money. And we're going to talk today about kind of, how would you capture our subject, Phon? What would we, what do you think how would you describe our thing today?
The essence of our discussion.
Well,
Yeah.
in terms of the markets and the economy, things look relatively okay now, but I think, we could be setting ourselves up for what I call a Wile E. Coyote moment. So we'll talk about that more.
So we'll come over that in just a minute. As usual, we want to talk about a couple of things. One is we want to introduce, as usual, our director of client fun, Amy, who is here behind the scenes.
Hello. Hi,
Hey,
hi,
Amy.
hi. How are you
Hey.
guys?
Making it all work. And
Yeah.
and briefly, today is what day?
Oh, sorry. Today, I actually picked a really good one, I think. So I'm always smiling, but I'll be brief. Today is National Smile Power Day. Just put on your smiles,
Oh, the
Okay.
power of smiling.
Power smiling. Yeah.
My
Yeah.
One
heart
thing the world
feels
could use
all
right
warm
now
and
is more
toasty.
smile power.
Yeah. Yeah. You could win just everybody's happy with a smile. Now, if you're grumpy, then you're just gonna get
I
punched
know
out.
Manhattan puts a happy smile on my face. So,
There you go. Yeah.
and while we're at it, too briefly, how many have we held now so far?
Oh, so today is number 146.
Oh, that's
Wow.
good.
146.
Yeah.
Get
Yeah.
to
Right.
154, we'll be up to a full three.
That's crazy.
Yeah,
Yeah.
Oh.
156. So anyway, okay. Well, you know, why don't you give us an idea of your background, the different, what experiences, work experiences? I know you've got a degree in finance and such, but what brought you to this place where you have a company that helps us manage folks' money?
Sure. Yeah. I feel really fortunate been able to work for a joint venture in terms of Citi and a bank in Saudi Arabia, where I think I managed about a $5 billion portfolio globally. And then most recently, I worked at Security Benefit, where I led the team in terms of risk management and derivatives trading, where I think we managed 16, 17 billion for Security Benefit. So yeah, I had a lot of institutional experience. But one of the things
And
which
for
I've always, sorry, go ahead.
many people listening know Security Benefit because they're one of the people we use for some of their annuities. That's one of our favorite companies. So we are probably sorry you left there, but happy that you're here.
Yeah, one of the things I always wanted to do was start a company and feel very, very fortunate making and saving a lot of money for large institutions. But how do we apply all the strategies for advisors and their clients? So that's one of the reasons why I wanted to start Veda. So we've been able to find some off-the-shelf ETFs and with options in them and risk management strategies in them and put them in a portfolio strategy for advisors and clients. So I feel very happy to be able to do that. So
Yeah, I always tell people he took off the shelf products and helped them do the fancy things you could do when you were just managing 15 billion and could go right to Wall Street.
yeah,
So
and we'll talk about a little bit more, but like some of these new ETFs that came out, like these buffer ETFs came out. The first buffer ETF came out July 2019, which has been really helpful in developing these strategies. So we'll talk about that in the future. So yeah.
Okay, well, I'll tell you what, I'm going to crank up. We've got some stuff to look at to help us explain this as it goes along. And let me go get it started here. There we go.
Yeah.
And I think you mentioned this little fella.
Yeah, so those that can view it, I'm pretty sure it brings back the childhood days of watching cartoons. But if those are listening, it's a picture of the Wile E. Coyote cartoon, kind of famously running off the cliff, and
That's the moment that you realize.
yeah, realize, oh, things aren't as good as they seem. Which the U.S. economy and markets might have that moment in the next 3 to 6 months or 9 months, but got to be ready for that when it comes. No one knows when it's going to happen, but we should be ready for that in my mind.
I know there's been a lot of talk in the industry where, if you look at a lot of the things going on, if you look at what's going on in numbers on paper, it shouldn't be as good as it is now. It's kind of like they often wonder, do people just refuse to believe? It's kind of might be like the Wile E. Coyote who runs out there and thinks he's okay, and then all of a sudden it comes on him and down we go. But let's go into some of the things you prepared for us. This is one. This is titled Major Headwinds, Liquidity and Money Supply. What are we looking at here?
Yeah, so this is a 50-year chart of the percentage change in US money supply from the 70s to now, which is really, it's pretty
So down here
dramatic
we
when you
have
look at it.
like, if I can get this thing to work, come here, be good. If I can go down here, this is like 1975 here on this end. And this is now up here.
Yeah. So you see that large spike up there, David and viewers?
Yeah,
and
if you
Samantha?
follow it along, it's been going and now we're way up.
Yeah. So that was COVID. If you remember during COVID, we had those lockdowns, the global economy shut down, and then the government and central banks started flooding the money with the liquidity. And then if you remember, they kept telling us that if inflation wasn't a problem, but then inflation finally picked up last year, and now they're doing the reverse. So money supply is collapsing, interest rates are going up. So it kind of, at some point, like we're gonna kind of run off a cliff. We just don't know when, but had the largest increase in money supply, and we've had the largest percentage decrease in money supply. So I think we've seen bits and pieces like Silicon Valley Bank fail and other banks fail.
Let's see. We've got some more stuff on the money supply here from
So this is the Federal Reserve balance sheet. So this is 2000 to 2023. So the Federal Reserve balance sheet has increased by 9 times, is 1 trillion to now 9.8 trillion. So that's very supportive of the markets and economy. Basically, the Fed is injecting money into the system when the balance sheet increases. And when the balance sheet goes down, basically the Federal Reserve is taking money out of the financial system. So they've started taking money out of the financial system. If you zoom in, David, to the smaller one, the other graph there. So they started taking.
We blew this area up and he put it here.
So we peaked around 9 trillion, and then the Fed
this.
started raising rates and decreasing their balance sheet. And then that spike there was Silicon Valley Bank failure. It was only 3 months ago when everyone thought the world was falling when the banks failed. Now everyone's feeling happy, but the Fed increased their balance sheet by about half a trillion, which really kind of ring fenced the banking system. If they didn't do that, I don't think the market would be rallying. We'd probably still be down, but that shows you the power of the Fed balance sheet. So now we're back down to pre-Silicon Valley Bank news. So that's another potential headwind. You got money supply, and you got the Federal Reserve trying to shrink their balance sheet along with high interest rates. So. In this slide here, we show the government debt, which is really kind of crazy. Like we might surpass, or we will surpass, debt to GDP. It peaked during World War II. Now we're gonna probably surpass that. And
yeah, if we look at it, this is 1903. This is 45. So this is World War II here. And this is basically how much debt they put out, how much basically how in hock the government is.
Yeah, kind of total debt divided by US GDP relative to GDP. This is percentage. Yep.
Debt to GDP ratio. Okay.
Yeah, so those
And-
numbers are not looking good. And then, including all the social security and other unfunded liabilities, the picture's not good. So those
So
are
we're
other,
almost up to where we were in World War II, and we spent all that money to, you know, to win to win the war, basically.
yeah.
And it looks
If
like they're
you,
projecting even more.
yeah, if you zoom out, David, so like the debt ceiling was good, but it actually means that there's gonna be more money sucked out of the system. So the treasury is gonna issue about $1 trillion of debt. So that's another $1 trillion being sucked out of the system. So that's another major headwind, along with our deficits. Unfortunately, the US deficit keeps going up, which generally means the US government is becoming more and more of the economy, which is generally not good in the long run. So those
That's
are
a lot
the
of dollars. That's a
yeah,
lot.
so those are 3, 4 of some of the 5 major headwinds could cause us to go over the cliff at some point.
Yeah, what we
I
got
think
here.
lastly, sentiment. At the beginning of the year, a lot of investors, including myself, were pretty cautious. But now, if you look at the CNN fear greed indicator, at the beginning of the year is fear and greed, but now it's extreme greed. Especially the last 2 weeks, we sense a lot of people chasing the market now. So that's another data point. A lot of people are chasing the market and now getting bullish.
This
As
is
the
kind of a
market.
survey or a number developed by CNN. So it's boy, if you think back, you remember 1999, 2000, we had the dot-com bubble where everybody was, buying in, and then we had the 2008, 2007, and 8, we had kind of the real estate bubble. And the question is, are we sitting here now, again, into this extreme greed thing where people think everything's all well?
Yeah, if you scroll down, David, kind of like I think a lot of people have seen it, like 5 to 10 stocks have driven the stock market this year, which is like Amazon, Apple, and Nvidia. If you take those 5 to 10 stocks out, S&P and NASDAQ is actually flat to even down. So it's been very narrow, which is like
Wow.
only
This is an interesting graph. I'd never seen this graph until Phon brought it to us today.
That's 10%, not 20.
Oh yeah, 10%. Okay, 10. You're right. But what this means is, when the S&P, the way they calculate it is big companies get more votes than small companies. It's proportional to the size of the market. And if you went and instead of you did equal weighted, where every company in the 500 companies got one vote, and you looked at how the S&P was doing, it'd be down 10% instead of up like it is. Because 5 companies are driving all the whole thing?
Yep,
And they're
5
the
of the
big
largest companies. Yep.
Yeah, we got Amazon, which it's
Apple,
Microsoft.
Microsoft, Nvidia, Amazon, Google, the mega cap names. Yeah.
So we think it's great the stock market's up, but in reality, it's a tiny chunk that's up. There's a bunch that aren't, and it's like, does that mean danger or an opportunity? It's kind of it's an interesting situation. But this is a graph, that's kind of what it means. When these lines are below 0, that means overall the market's down. So on a 1 vote for each stock basis. So
Yep.
Interesting.
We have a question from Bruce. I can answer really fast. He's asking if what the federal government would do to fund the Social Security once it's depleted. So that's a very complex question, and but one thing which they have to do is they need to increase the age which people can unfortunately pull Social Security. So that's the first step, Bruce. And then so combination of increase the age, decreased benefits, and try to slowly inflate. So those are three of the four things that they're gonna have to do in the long run, but it's a very complex and socio-political problem we face as a whole. So
What do you think the age would have to be? What do you think they have to take it to?
that's pretty high because like Bruce said, we don't have much money left. And what's the age now? 60, 62 or 65? I think 65, is that correct? 70. Yeah, people are
62,
getting.
you-
people are-
can take it. 70 is the latest. It makes sense. Most people, their full retirement age is 67 at this point.
And it just, you know, with the Social Security, we should do one on it. It's just so depressing. I hate to,
Yeah.
that maybe what about this? What's this, you know, outlook or this view of the world look
Yeah,
like?
this is like another contrarian indicator. Like I said, at the beginning of the year, a lot of people were cautious and bearish and weren't investing in the market. Now that gets a lot of the polls have flipped. So after the market's already up 10%, the S&P, people get bullish, which I always find kind of weird, but to me it's a contrary signal and we should start
If-
being
If
cautious.
it goes above zero, that means there's more bulls than bears, you know, percentage wise.
Yeah, I kind of grew up studying Warren Buffett and kind of really believe in his philosophy of being fearful when others are greedy and greedy when others are fearful, versus jumping on the bandwagon. So, yeah.
That's smart. I like it.
So, and right now, I think you brought us these two.
Yeah, back to the
barons.
contrarian theory of media and in polls is the classic cover theory, which works pretty well. Either the Economist or Barron's or some big publication. Last year there, which three months later was near the bottom, and now they finally kind of capitulated and put the bull market in. So 2 to 3 months down the road, we'll probably see a correction. So, yep.
I like that. That's interesting. I like it.
Yeah.
How about this?
Yeah, so I think this is the last slide before we talk about buffer ETFs. So just a reminder for everyone, like we forget like Silicon Valley Bank, a lot of banks went bankrupt, you know, Russia invaded Ukraine, COVID, flash crash, European debt crisis. There's a lot of these headlines lurking in this dynamic global economy. So we got to be prepared and ready to take advantage of the volatility. In my mind, it's kind of been a gift, this rally. So consider taking some chips off the table or going to some hedge strategies up here, because eventually the market and the world's going to change pretty rapidly. Yep. And also, I think, David, the other graph, we've had one of the calmest years so far, 2023 versus past years. I think the worst day was down 2% versus other years down, you know, you seen down 2, 4, 5% multiple times. If you also remember during COVID, market was down 8 to 10%.
I found this to be a fascinating graph, and I know if you're watching on a little screen, you may not know what it means, but this is 2020, and on this horizontal axis, this is minus 12, this is plus 10. You see in 2020, we actually had, each dot is how far the market moved in a day. On this day, we actually had a day where the market fell 12% in one year, and days where it went up almost 10%. I mean, it fell 12% in one day, and here it went up almost 10% in one day. You can see there were a lot of days where we had big swings, and it was, right now we're real tight. We haven't had many crazy days this year yet, you know? So is it mean we're calm from now on, or is it the calm before the storm, you know? But you can see what the storm looked like, and COVID was one of the worst storms we've seen in terms of rapid change in time. But this is an interesting one. But we got to move on to a couple of the favorites here.
Yeah, I developed this graphic, and for those who are listening, I have a graphic of someone with a 2-pack ab versus 6-pack ab. So I like to think of our portfolios as kind of like your six-pack abs. We have multiple asset classes, multiple strategies to give you the best return and give you the smoothest ride possible, versus the traditional 60-40 portfolio, which kind of just stocks and bonds. We have buffer ETFs, we have gold, we have direct hedging strategies, all on top of a tactical systematic trading strategies. So
I
Yep.
like to think that under my keg, there's a six-pack ab waiting to get. But, and
Definitely.
here's another view, here's
I think
kind
I got
of,
that. I got that picture from you, David. That's David's.
and this is another way to view it. Most, most, most people have a 60-40 mix, a balanced portfolio. You got stocks and bonds. And these fancy strategies have stocks and bonds, but we got all these other things to help us weather the storm on the downside in particular. So it's
Yeah.
kind of, and let's look at one of them. One of them is what, a hedged ETF?
A buffered ETF?
I'm sorry, a buffered ETF. If it kind of says you go in here and you buy now into a buffered ETF strategy. And what happens on the upside? Typically now, what's the cap on the upside of a buffered ETF about now?
About 12 to 13% for 20 buffer.
So if the market goes up, we get the first 13, we can, a year from now, we can capture up to 13%. What happens if it goes above 13%? What happens if it goes here?
That's your maximum return. You kind of get capped out.
You don't get that. You lock in, you could lock in that 13%. What about on the downside? If over the next year the market fell, what would happen to your, what's the part you don't lose?
Yeah, that's the beauty of these structures, kind of giving up some of your upside, but you protect a lot of your downside. So the market has to go down 20% for the ETF to lose money, which is essentially a bear market, which is.
So this is sort of, I don't lose anything. And then here is the risk. If I fall 22, what would I lose?
You'd be down 2% net.
So kind of a nice.
That's not bad. Yeah.
One of these new buffered ETFs, you said they just came out in 2019, right? And why don't you go over, here's an example of one where the upside is 12 and the downside is 10, I think. What's the first example here on the first column?
Yeah, this is what we call a 10 buffer. So here the cap is 12 and your downside partial protection is 10%. So in a very bullish scenario, which is the right hand side. So let's say the S&P is up 14%. At the end of 1 year, the maximum return you're going to get is 12%, which is still pretty good in my mind. Nothing to sneeze at, 12% up year. But if the market's up 8% within the cap, the other scenario, you're up 8%, kind of match the market up to the cap. And the beauty of it, the market's down 8% or 9.9%, you should return roughly flat. And when I say roughly flat, that means there's an expense ratio. So the ETF 0 minus the expense ratio is generally 79 basis points, 70 basis points. And then if the market's down 20%, yeah, you just take 20% minus the buffer, so you'll be down 10% in this example.
So it's another idea how these work, kind of a picture. And those caps up and down vary, I think, with time. I've watched them change over these last. And one of the things Phon is great at is he's got the software to go in and find these, and you can buy them in between the year and all kinds of fancy things that his team and his lines of code do. And,
yeah, we have a lot of software programs and custom programming languages too. I think there's over 150 buffer ETFs in the universe, and we scan all those. Yep, feel really fortunate. There's a picture of me ringing the bell with Allianz. So we work with all of the big
I like it.
buffer ETF issuers like Allianz, First Trust, and Innovators. We're actually probably now either top 3 or the largest buffer ETF allocator manager in the United States now. So we feel very fortunate, and yeah, that's me. So yeah.
So a little,
I like how you circle it. That's cute. I like it. You look very
Yeah, I think
happy.
my-
It's
Dad-
good. It's like
My
good.
dad can't rest
know.
unless he's interacting
No,
with
he's got-
this in
yeah,
some
yeah.
way.
Yeah. Where does
Yeah.
that when he's not like drawing any pictures or any art for it? So we're all good.
I think
So
my
I
wife
thought
and boy- I think my wife and boys had a neighborhood watch party at 3 o'clock.
Oh, that's
That's so awesome. I love it.
Yeah.
well, so, we actually use, Phon has several different strategies that his company has produced. We brought them to many of you already. If you want to know more, give us a call and we'll have a chat. I also have arranged, let me do this. I've also arranged, we have a brochure from his company, the Smart Veda Hedged. I'm also seeing if we can get approved one of his white papers for those of you who are real gluttons for punishment and want to know the another deeper look at how all this hedging and all works. Let us know that too. You can get this if you're a real glutton. Say, send me the white paper too, and that'll be a great piece to make you sound really good at cocktail parties. You'll be able to.
I like it.
So that's and we have one more thing to do before we. So one more thing to do before we go, Sam. What's that?
All right, it is our wine drawing. Now you have to forgive me that I'm at the office and I don't have my normal cool bucket, but I do have your slips in here. So if this is your first time joining us, to enter our wine drawing, we give away 2 bottles of wine every week from Fermental Bottle Shop, and they are delivered directly to your door, and they are personally curated by Steve, the owner of Fermental, who was recently featured in, what was it, Garden and Gun magazine for one of the top bottle shops in the Southeast. So that's very exciting for them.
Nice.
But to enter and have 2 bottles of wine delivered directly to your door, all you have to do is either there's a Facebook event every week and you click that you're attending that Facebook event. And if you're on our email list, we'll send out an email letting you know what our topic is. And if you reply and let us know what makes you smile, or just say, enter me into the wine drawing, we'll get you in here as well. And then you could share either one of those with a friend, and you can get even more entries into my usually my jar, but today it's my box of tickets.
I like it. I know what that. I like that box. I think it's a good one.
It's kind of cool. Our winner this week of 2 bottles of wine delivered directly to their door
Drumroll.
are Susan and Barry R.
Ah,
So
Susan and Barry.
congratulations, Susan and Barry. You are our wine winners this week. To everybody else, thank you for entering, and please continue to enter, especially if you haven't. We love to give away wine. Now we've given away 146 times too.
Nice.
That's
And
a lot of
will
wine.
also-
That's
Amy will
$300.
also put in the notes our phone number and all to get, if you want to get together for a meeting for something else, if you're a visitor, you can arrange a visit or a phone call with us as well. We can get this in the accompanying white paper. And
Yeah, it's in the
boys,
comments.
we
So
covered a lot of ground, Phon. I didn't know if we could do that, but we did
Yeah.
get it all in. So I hope it's going to be interesting to see what happens. Are we the Wile E. Coyote or not?
ooh, that all I can
But
think
you
of is that
always-
like beep beep beep, like is
But
that
now
the
you
Road
know
Runner?
there's
Like
some
it's
ways to prepare for that. You can see how the hedged ETF can kind of maybe extend that cliff out a little further for the.
Very good. Extend the clip. I like
Fine.
that. I like that.
Exactly.
Yeah.
That's why having things to limit your volatility exposure is excellent part of a retiree's portfolio.
What are we talking about next week, Amy?
Ooh, it's a good one. Sam, you are on deck. So Sam is going to be talking about life insurance in retirement. So we have a lot of good information, like handouts and things too, to go along with that. So that's a good one. And then also, David, just so you know, we do have a Social Security one coming up July 13th. So yeah,
Okay, so July 13th,
for Social
we'll
Security.
learn about
Yes.
Social
For punishment.
Security.
Sam, you're so great. I love yours. And Pon, you're wonderful. So it's such great
problem.
information.
Yes, thank you
Great
so
Yeah,
much for
thank
joining us
you.
today,
Phon
Phon.
was here in
Yeah.
December a couple years ago. If you look back
Yeah.
through our things, you can catch his other one. We'll have to have him back here.
And-
Search
Maybe
directory.
more
Oh,
often.
and I was talking to Pon about getting him out here in person sometime.
Oh, I
So-
would like that.
Yeah,
Yeah.
so we're
Have an
gonna look
event?
into having maybe a live event with Pon here, so we
Yeah.
can.
You'd like to
That's
see,
cool.
I
if
like it.
you'd like to come to, we'll have it at some fairly big, reasonably sized place where we can fit us all. And of course, accompany it with something to eat and such. So we'll
That'd be
see you
great.
then.
Yeah.
Yeah.
Can't
Yeah.
wait.
Excellent. Well, thank you again,
I'll
Pon.
finish my beer.
problem.
Thank you,
Everybody-
everybody.
Peach.
Yeah, I think you got my Burger
Bush
King.
Light.
Oh, you got
Peach.
birth. I know you missed that, David. I was like, it's ridiculous. I'm in South Carolina on vacation. It's, you got to go with it. So
I'm drinking herbal tea. Today, though, a person came in, brought me a bottle of homemade wine, too. I've got 2 bottles of
Ooh.
homemade wine now, Benny. Y'all
That's
come and see
dangerous.
me. You got homemade. We love to have it.
All right, Dad.
Yeah.
All right, guys. Well,
Yeah.
thank you everybody for joining us.
Bye. Thank you, guys.
Tune in next week. We'll be here live 4:30 live on your Facebook page.
Yeah.
Cheers.
Cheers. Thanks,
Bye-bye.
Pon. That was great. Thank you.
Thanks, Pon.
Thank you.
Bye-bye.
Bye.